the great boss. We have done our due diligence on you, Ernest, and we had the pleasure of having your boss around as well.
Oh, Barry has done this podcast before.
Yeah, he has. He has. It was actually a huge success. I think a lot of people. It was it early spring, Kenneth?
Yeah.
And everybody bought Constellation software. So it has he has made his mark in Norway with people wanting to buy compounders in Canada.
Yeah, it's an interesting market. There's a lot of, like serial acquisitive companies for whatever reason. And being in Canada, I think it's sometimes hard for, like, names that are household names for us here are probably not household names for you guys in Norway, and vice versa. Like, you probably have companies that the investment community loves there, but then I've never heard of the company.
Yeah, probably. But you have heard of Circle K.
Yes,
Yeah,
that one. Yes.
it's the largest gas station and convenience store in or chain in Norway.
Yeah, I think they have a large. One of the interesting things about Norway is, like, the electric cars, right? I think they have the highest penetration of electric car sales in the world, but yet gasoline consumption is still pretty high.
That's true. Yeah,
Uh,
that's correct.
Do you know, like, first of all, why is it so, like, why is the electric car penetration so high? Is it government incentives?
It
Is
was
it
it was the incentives, Ernest, but now they have increased. They have increased the taxes on electrical cars over a certain amount of weight, you know. So
right?
or horsepower. I don't know really how they have measured where you get the positive incentives and where you get the negative ones, because now a lot of people have actually more interested in buying a large fossil fuel car because the incentive is gone.
Right. Got it. That makes sense.
The information and opinions expressed in this show should be considered as entertainment and for educational purposes only. We're here to inform, enlighten, and make you laugh, but we're not giving financial advice. Any information in this episode should not be relied upon while making investment decisions. If you're looking for financial advice, please consult with a professional financial advisor. The hosts and guests may or may not hold positions in the securities we discuss. Welcome to Stock Up, a podcast about the capital markets and stocks. Today we are very happy to welcome a special guest from Canada. Our guest is the head of research and a portfolio manager at Baskin Wealth Management, an asset management firm with over 2.5 billion in assets under management, probably a little bit more now. Our guest is also the co-host of the excellent podcast Long Term Investing, which we recommend to our listeners. Please welcome Ernest Wong.
Happy to be here.
Really happy that you're taking the time to discuss with a couple of Northerners from Norway. For those not familiar with your backstory, could you just give a brief overview of your background and how you ended up at Baskin Wealth?
Sure. So I've been at Baskin Wealth Management since 2016, so a bit over 8 years now. I grew up my whole life in Toronto. I went to the University of Toronto and I studied accounting. And then I worked at a variety of roles before joining Baskin, really as a dedicated research analyst before being the head of research, which is what I'm doing today.
Cool. So, what do you do when you are heading the research department?
Yep. So, as you very nicely put it in the beginning, we are a wealth management firm with about $2.5 billion under management Canadian. We manage largely separately managed portfolios for high net worth clients. And my role here is really to manage the equity portfolios for that go into the models for our clients. And our investment strategy is really focused around owning a fairly concentrated portfolio of high quality businesses and just own them over time. And that approach has worked pretty well for us.
That sounds like a lot of fun. So that's a perfect transition over to one of the subjects that we wanted to go deep on with you. And I've done my reading on your website, and you have this very nice equity investment criteria: moats, culture, capital allocation, evaluation. But the one we'd like to talk a little bit about is the tailwinds.
Yes.
What do you mean by tailwinds in the context of your investment criteria?
So I think it's pretty simple. I think you'd rather own businesses that are facing tailwinds, like they have secular growth opportunities. The industry overall is growing, rather than one that is facing headwinds, like a declining business, so to speak. One of the things that I think we're very careful about in terms of evaluating tailwinds in a business is to really see where the growth is going to come from. We want companies that have a clear competitive advantage and a clear value proposition over the competition in that industry. So, one example that uh, kind of an obvious example in our portfolio of that is Netflix, right? Netflix has a clear competitive advantage in video streaming, uh, which is gaining market share over linear TV in basically all around the world. And the value proposition of streaming versus linear cable TV is obvious. It's cheaper, has a better user experience, has more content. Um, it's more accessible on a variety of platforms. And so it's not hard to predict that streaming is going to continue to gain market share over traditional linear TV over time. And that's generally what we prefer to own rather than, kind of like a vague, oh, like the world is going to use more AI, right? So it's a little bit more concrete, and we pay a lot of attention to these industry dynamics.
Yeah, that sounds excellent. So, how, with respect to choosing between which tailwind you'd like to investigate more, so how firm or how much potential, what do you like to see when you go down a path, and like with Netflix with the streaming and narrative and tailwind, what got you to be interested in that? Was it the total addressable market size, or?
Yeah, it's more around, I think it's really more around the competitive advantage that the businesses have. Like the industry itself, like ideally it's one that is growing, uh, and because that supports industry growth and the growth of the participants within that industry. But then you also want a company, as I mentioned before, that is has a structural reason why they're gaining market share over other players, and rather than just growth of the entire industry. So another example that of a different industry is in the North American pizza market, which is Domino's Pizza. Like we own Domino's Pizza, and Domino's Pizza has a clear competitive advantage over other pizza chains because they have the lowest prices, they have the best franchisee unit economics, so their franchisees make the most money, uh, and their main competitors are they can't match the prices and the speeds that Domino's can provide. And so I think it's not hard to predict that Domino's is going to gain market share over both over independents and both against larger chains like Pizza Hut over time. So even though the pizza market overall is not like a very fast growing one, That's I think that's it's really around the competitive advantage that the company would have.
What do you look for regarding those tailwinds? Do you have any red red flags when it comes to, oh, this company is going to lose their steam? And is it the moat or is it the trend? Because it seems like everybody is joining the AI boom, if you know what I mean.
Yeah, I think we try to be a little bit more specific around why. Like you have to have a concrete reason why one business is going to gain market share over another. So going back to the Domino's example, if you look at Domino's business model, like they just have a clear, like they beat Pizza Hut on basically every aspect. Maybe taste is just debatable, like whether you like Domino's pizza more or Pizza Hut pizza more. That's debatable, but on price, on delivery speed, on technology, like they're clearly ahead of Pizza Hut, and they have been gaining a lot of market share. I think the one other thing that I would say is that, and this is how we underwrite growth for all of our companies, is like how much conviction do you actually have in the growth opportunities that are presented? So being in Canada, I think one of the things that we care a lot about is ensuring that the growth that we're underwriting is taking place in a place that we understand. So Domino's is gaining market share in North America. It's a very North American centric strategy, and they have an international expansion plan, but that's not what we are really banking on for the stock to work. Whereas if you contrast that to something like Nike or Starbucks, where 100% of the growth thesis is coming from China, I think it's very hard for somebody like me sitting in Canada to evaluate whether Nike or Starbucks is going to be successful in China, just because it's a totally different market. Is one that I don't I don't understand the dynamics of it. I don't understand the competitive landscape. I don't understand, like the consumers and how they like to buy shoes and coffee. So I think that's one of the things that we're very unlikely to be. Uh, we're very unlikely to make a bet on something like that.
See, and let me just be clear. Here in Europe, we have some real issues regarding cheap energy prices because of the war in Ukraine, between Russia and Ukraine.
Right.
We have seen the gasoline prices explode 30-40% just in 2 years. The gas prices and the electricity is 200-300% more expensive just within 2-3 years. So the competitive advantage for our peers in North America, even if it's the Canadian ones or the US ones, you are many steps ahead of us on innovation, and companies have a competitive advantage regarding cheaper access to energy. So I get why you bet on your own horse.
No, and I think that's an important point because I just went on a trip to Asia, and it just reinforces that the world is a big place and people live in different ways in different places. So in Japan, for example, like women don't wear yoga pants. That's just not part of their. That's just not the way they like to dress. So and but then in Canada, like I think it's very common that you would see women wearing yoga pants. You know, maybe not going to work, but in their day to day life. And so if you're evaluating something like Lululemon, then it's tricky if you start trying to underwrite their growth in places that you don't really understand.
It's a huge cultural difference, I think. Even though I think we in Europe, especially in Scandinavia, we are looking always over the sea to the US. all the trends start in the US, and give it a year or two, and it's here as well.
No, and I think with regards to your point about energy, this is a bit of a side note, is that even though Canada is one of the largest energy producers in the world, it's not evenly distributed among the country, because we're currently in Toronto, which is quite a. If you look at the map, it's quite a bit of a distance away from Alberta, which is where all of the oil is, and we actually buy most of our oil and gas from the U.S. because in Ontario, because it's a lot cheaper and it's a lot closer and the infrastructure is better. So yeah, just because we have energy doesn't mean that like the whole country is just swimming in oil and gas, although we should be.
I get what you mean, and we have the same issue in Norway. And we have the largest national fund in the world, Norges Bank, Norwegian. The Norwegian central bank have their mandate to. I think they own 2% of all the global stocks, if I'm not mistaken. And the thing is, we see, even though we are kind of the only energy source in Europe now, the inhabitants and the people in Norway are also paying for higher energy prices, even though we are self sufficient for those kind of commodities. And that brings me kind of over to a common stock I know Baskin Wealth Management holds, and which I've held for some time now, and it's Canadian Natural Resources. Would you
Yep.
say that they have the tailwinds that you describe in on your website as well, of one of the criteria you have for
Oh
investing?
yeah. Well, okay, so I think there is a common uh, perception that an energy company can't be high quality business because they're a price taker. They don't control the price of oil, and they sell a commodity. But I think one of the interesting things about Canadian Natural Resources is that Canadian Natural's oil reserves are in what we call the oil sands. And this is very different than like a conventional oil well where you kind of drill it and the oil comes out and then you process it and refine it. Oil sands are much more like a factory. It's like a mine. You just basically go in and dig it up, and the beauty of this is that it doesn't deplete. So in a conventional oil well, the like the first the in the very beginning, you get a lot of oil, and then the well slowly declines in productivity over time. But that doesn't happen for the oil sands. Just because you extracted oil today doesn't mean it's any harder for you to extract oil tomorrow or even 10 years from now. And so, and the reason that matters for Canadian Natural is because they don't have to go out and find oil. They have, I think, as of the last date, they have 50 years worth of production reserves. So the only thing that matters for them is essentially lowering the cost of production, and that's what they do. They have an outstanding CEO, management team that is really focused on lowering the cost of extracting the oil and getting it to market, and that's what they do. Um, they have a great track record of buying things when they're cheap, improving operations, and generating free cash flow. And I think that it's one where the market doesn't adequately appreciate the quality of the reserves that they have, because I think maybe for good reason there's a view that Canadian oil and Canadian oil sands are in trouble and haven't done very well for a while, but I think that will change soon.
Yeah, and I think one of the reasons Canadian Natural Resources has held up in this market is first of all, they are returning all of their free cash flow to their shareholders through buybacks and dividends. But I think you can see that they are one of the best in their class. Really, the oil prices have plummeted from its peak in 2022, and Canadian Natural Resources have just kind of after the stock split just been a cash cow machine, because they are giving you a huge part of their profits to directly to their shareholders, and their share prices have held up quite good. Do you think it's a coincidence, or do you really think that other people see the value in Canadian Natural Resources to kind of trust the management there?
So I think there's another dynamic that is that Canadian natural and the Canadian energy industry overall is benefiting from. So if we go back 10 years, before 2015, 100% of Canada's oil and gas production essentially was exported to the US. And so and that was because the US was a net importer of oil, and Canada was a huge oil producer, and there was no need for Canada to develop the infrastructure to find other markets for their oil and gas. So what happened in 2014 to 2015 is shale, right? In the US, they because of the shale revolution and fracking, they suddenly went from a net energy importer to a massive energy self-sufficient country. Oil prices fell, but made worse for Canada is that we no longer had an export partner. And for the last like 8, 9, 10 years, basically since 2015, Canada has had to develop pipelines and build the incremental export capacity to be able to export their oil and gas to other markets, like in Asia or Europe or those kinds of places. And so the reason that I think it's going to turn soon is because a lot of these projects are finally getting completed. There was one called Enbridge Line 3. There was a Trans Mountain pipeline expansion. You can Google that. And in 2025, there's the LNG Canada, which is the first LNG plant ever in Canada, which is kind of crazy if you really think about it. And so as these projects get completed, the Canadian oil discount is going to narrow. And we've already been seeing this with Canadian Natural, where even in a fairly weaker oil price environment, the price for the discount that heavy Canadian oil called WCS is receiving is narrowing. So that has been a bit of a tailwind for Canadian Natural. And you add to the fact that Canadian Natural sells most of its oil in US dollar pricing and produces in Canadian dollars. And so that has been another tailwind over the last 2 years as well. So, but then I think on a big picture perspective, the key for Canadian Natural is that number one, they can continue to match production with the export capacity growth. So they can grow production. I think the CEO has said he can double production today if he wants to. It's just a matter of being able to move it to different markets. And number two, it's really around the government and the country as a whole figuring out the emissions that are generated from the oil sands, because they're it's called dirty oil for a reason, because it's a very carbon intensive extraction process. And if they're able to figure that out, I think that will be something that allows them to continue to increase production as well.
That sounds great. Sounds like great tailwinds. From what I've seen, you have a lot of medium-sized and smaller-sized oil and gas companies in Canada. Are there any other good bets that you like? I see that, for instance, like Tourmaline and Arc is doing quite well.
Yep, there's another one that we own, which is Tourmaline Oil, which is a bit of a the name says oil, but they're really a natural gas producer primarily. And that's another one where the the CEO is just a superstar. Uh, he's done an amazing job at building Tourmaline Oil. This is his third oil and gas company, and I think he's so respected in the Canadian energy industry that he was able to raise money to build a new company in 2008, right? Just think about that. And in from 2008 to today, 2024, so 16 years, he went from nothing to build the largest natural gas producer in Canada. I think that Tourmaline is going to benefit from, and the gas industry as a whole. Like, I think they benefit again from the completion of LNG Canada, because Canadian natural gas prices have essentially uh, been almost zero and negative sometimes, because there's no way for them to move it to market, and that's going to change very soon. So it's going to benefit producers like Tourmaline, but especially producers like Tourmaline, because they have the scale to be able to move the product to different markets and get a better price for the natural gas that they're extracting. And they've also been making acquisitions in this weak period of time. So that's that's another one that we like quite a bit.
Yeah, it's legendary, the CEO there. And yeah, I've been looking at them for quite some time as well. So it's a very interesting company. So if you could transition over to another part of the, not maybe energy sector, but we have quite a few members in our community that like the Brookfield companies,
Yes.
and they are many of their businesses are being pushed forward by the tailwind of renewable energy, environmental regulations, and stuff like that. You guys also like Brookfield, don't you?
Yep. We've owned Brookfield. Well, formerly Brookfield Asset Management, but now Brookfield Corporation. We've owned it for 20 years, basically, before I joined the firm, and it's
Wow.
been it's been a spectacular performer. I don't know what the reasoning was 20 years ago when they bought it, but it's done very well, and I think it'll continue to do really well.
Yeah. So they
I
have.
think Yep. So I think for those who are not as familiar with it, there is Brookfield Corporation, which manages the capital. It's like kind of like Berkshire Hathaway in a sense, where the leadership team is investing the capital of the corporation, and then they have Brookfield Asset Management, which is the asset management companies which earns fees on managing third-party funds. And Brookfield Corp owns 73% of Brookfield Asset Management, but I think we get a lot of questions about which one we like more. We prefer Brookfield Corporation, just because that's the one that that's the mothership. That's the one that the insiders own the most of, and that's the one where you can really see the compounding benefits over time from reinvesting their capital at good rates of return. So we just did a podcast on Brookfield Corporation today. I think it'll be posted in a couple of days, so you can keep an eye out for
Okay.
that.
Yeah, we will. That's a great timing. Yeah, because many of the businesses under the Brookfield umbrella, like the Brookfield Renewable, they have a really impressive um, hydro portfolio, and they're also scaling up in solar and wind as well. So they are really leveraging this pivot to renewable energies. Is that a kind of a tailwind that you foresee will have a decent growth rate, a growth runway?
So Brookfield's largest focus historically has been on like infrastructure type assets, and there was a deal lately where BlackRock, the ETF provider, they bought a company called Global Infrastructure Partners at a very high multiple. And the thesis, BlackRock's thesis for Global Infrastructure Partners is that as the world transitions to a net zero economy, as the world builds data centers for AI and all these kinds of things, and as the world replaces all the infrastructure that was built in the post-war period, there's going to be a massive requirement for infrastructure spending over the next 30, 40, 50 years. And because governments are largely indebted around the world, it's going to have to come from private capital sources like BlackRock or like Brookfield. So the reason that I bring this deal up is because Bruce Flatt at Brookfield has been saying this exact thesis for many, many years. And the fact that BlackRock had to go out and pay a premium to acquire these capabilities, in my mind, it 100% validates what Brookfield's business model, where of only large asset managers that have the scale and operating capability is going to capture the large benefits from the infrastructure spending going forward. And I think that if you look at their track record of raising capital and developing new products, I think they're going to do very well.
Yeah, I agree. I was just going to say that Larry Fink probably watched the investor presentation that stole some ideas probably, but yeah, it's a very large addressable market. So, and the Bruce has been talking about this for a very long time, indeed.
Right.
So yeah, that's great.
But Ernest, I've had this kind of debate with Barry, and we both agreed that the US have the best companies in the world because of their innovation and their strong universities and brilliant minds and the kind of culture of making a buck and so on. It kind of runs through their DNA. But if you can look inside Canada, you have Brookfield, you have Canadian Natural Resources, as we mentioned, and I also listen. I'm a frequent listener to your podcast as well, and you have mentioned Costco many times, and you both love ATD, even though you bought it first time this year. But why don't you own the best compounder in Canada, which is actually Dollarama? They had their earnings released today, and it was a stellar beat on both top and bottom line. We have discussed this previously. Why haven't you bought into that story yet?
I think we well, oftentimes when people ask us why we don't own a stock, I would say it's more because like I think that when we looked at it, we probably concluded that the stock was too expensive at the time and underappreciated the growth that ended up happening at the business. I think we have looked at Dollarama several times in the past. I think the one thing that we got wrong about Dollarama is that we thought that their price increases. So maybe for some background, Dollarama is a Canadian dollar store. It's the largest dollar store chain in Canada, and as with most dollar stores, they have like a price points: $1, $2, $3, and they've been adding price points to this business like $4. And I think originally we thought that there was a limit to how many price points they could add, because they're just basically covering inflation. And I think that at some point the consumer would just go to Walmart or go shop somewhere else. I think what we underappreciated was Dollarama's ability to improve the inventory selection and improve the quality of the products that they're selling when they're adding price points. and that's been a I think that's contributed very nicely to their success over the years, especially given the fact that there isn't really a competitor, direct competitor to Dollarama, in the sense that you can go in and know that you're going to only have to pay $3 or $4 for a product. So today, I still, if you have to ask me, I still think the stock is like pretty expensive for what it is. I think it seems to me that the store penetration is quite saturated. Like there's certain areas in Toronto where you can see Dollarama like across the road from each other, but they continue to report really good numbers. So it's one that we should have owned.
It's always easy to look in hindsight and see, oh, I should have bought that one. But
Exactly.
I was really impressed by the investor presentation last year, because I got I got interested in the Canadian market, and the three stocks that I own is actually Dollarama, ATD, and CNQ, which have done really well for me. But 2 years store payback period on average for Dollarama is extraordinary. I've never seen anything like it ever. Even here in Europe, you have a company in Poland called Dino Polska, and you have Lidl and Aldi, the cheap store retail stores as well. They can't compete with the numbers that Dollarama has delivered, and they are going to expand their store target to around 2000 by 2031, which will also, if they continue this growth with their stable net profit margins and compounding at high double-digit growth on both top and bottom line, I think you have a nice story still ahead with a forward PE of 31, if my data is correct.
No, I don't disagree with anything you said. Like I think that like they've obviously done it. I think this is one of the things that often happens very frequently with great businesses, is that they never become cheap. And then if you look at it at any point in time, the stock will look expensive, but then it often keeps going up because they continue to do a great job of executing. And Costco is another one where I think like I think anybody who's looked at Costco stock over the last like very, very long time, you probably thought the PE was too high, but then the stock continues to go up. And I think Costco is a better business than it was like 2 years ago, is much better business than it was 10 years ago. So I think, to your point, I think one of the things that one of the lessons that I've learned several times is, if you buy a good if you see a good business, then you should probably just buy it rather than worrying about like whether you're paying a PE that is like a little bit higher.
Yeah, I totally agree, because I just we had this debate on this Discord channel, and we talked about. I think I'm one of the few members here who have owned Walmart for over 3 years,
Right.
and they have given me an amazing return. But it's also based on the PE expansion, and I have to admit, I wouldn't be dollar cost averaging on Walmart at these levels. And to your point, Costco is also expensive. Do you see a tailwind within retail? These kind of defensive retail stores, companies like Mercado Libre, Dollarama, and ATD, and Costco and Walmart and Amazon.
Well, it's interesting that you bring this up, because I think it goes back to the beginning of our conversation when we were talking about the circle of competence. Like dollar stores in Canada are doing really well, but then the dollar stores in the US are struggling very mightily for a variety of reasons. Like Dollar General, there's like Dollar Tree, like I think they're all trading at like many year lows. And so I think we'll see how that plays out. For something like Costco, I think that they do well in all environments because the value proposition is so clear. The value proposition, like the pricing spreads, the experience, the quality of the products you're getting, it's basically impossible for anybody to be able to match that at Costco. So in an inflationary environment, I think people want to shop more at Costco because like they're getting good value for their money. But in like a more deflationary or a more normal period, I think Costco's still gaining market share because people in all environments are going to want to get more for the same dollar. And so I think that goes back to your original question about what kind of tailwinds that you like to find. And I think that's exactly what you want to see is a company that has a structural competitive advantage over their competitors so that you can be pretty confident that they're going to be gaining market share over time, regardless of what the economy is looking like.
So, do you guys in Baskin own any of these names apart from ATD?
Yes, we own. Yes, so we own Alimentation Couche-Tard. We own Costco. Retail, we don't really own that many because retail is generally a pretty tough business. It's very low margin, like high fixed costs. Uh, it's very sensitive to changes in like rents and labor, and often questionable pricing power. And so those are the only two direct retailers that we own. Most of the other businesses that we own are generally not like that.
So, would you say that one of the reasons you also haven't owned Dollarama is because of their exposure in Latin America as well? It's kind of outside your circle of competence, or is it insignificant?
No, I don't think that's super material for Dollarama. I think if they figure it out, it'll be great. But no, I don't. That's not why we don't own the stock. Like the reason that we don't own Dollarama is just that when we looked at it, we thought it was too expensive and continues to be trade like at a fairly lofty multiple. And we like in hindsight, we should have bought it like many years ago, but we didn't, and maybe one day we will.
But let's get back to Baskin. If you have an
Yes.
idea, Ernest, and
Yeah.
you go to your boss Barry and say, "Look at this company. Look at the potential here. What are you screening for? What is
Yeah.
the favorite parameters, and how do you kind of discuss those kind of stocks or high quality businesses?"
Yep. So that's a good question. So the way we do it is we will replace a name in our portfolio if it's higher quality and higher growth and available at a more attractive price. And so one of the things that's important to understand about Baskin is that we have to be fully invested at all times. Uh, we are not allowed to hold cash for our clients uh, unless unless the client specifies that we can. So for us, it's all relative to what we have in the portfolio. If we want to add a name, because our strategy is buy and hold good businesses, and most of the work that we do is just to study if a business is something that we might want to own in the future, rather than looking at something uh, that is more immediately actionable. So one thing we wouldn't do is like we see Dollar General stock down 50% and go and do a write up on Dollar General and see if it's good value. Like that wouldn't be something that we do. We would look at names that what we would do is look at a company and see if it is a high quality business. And then if it is a high quality business, we'll look at the valuation and whether we like it more than something that we have in our portfolio today. And I think this is partly what goes into the Dollarama, your Dollarama question, is that I don't think I would prefer Dollarama today at Dollarama's price versus what we have in our portfolio. And that doesn't mean that won't change in the future. But that's generally how the portfolio approach works. Now, I think things happen from time to time, like maybe like the business turns out not to be as great as we thought it was, or maybe there was a takeover, and then we'll add another name to the portfolio. But we generally don't. We're not very active in managing the portfolio. Our preference is to just have good companies that are run by good people and just let them create value over time.
So, how do you? This is maybe one of the toughest questions out there. How do you value a good management? Is it only return on invested capital or return on capital employed you can use to actually see if the management is doing well? How do you think around that kind of importance when you're buying a stock?
I think you really have to look at the track record of the management and what they have done in the past. How do they deploy capital? Do they generally have a long-term mindset or a shorter-term mindset with regards to how they manage the business? Do they have a track record of being kind of proactive, or are they generally slow to react when there's a problem? Do they generally tend to be no like are they do they generally have a track record of being over optimistic about their businesses? So I think those kinds of things are important. And one of the things is, if you follow a business long enough, then you start to develop a pretty good sense of how they are likely to react to things. And that gives you more confidence that even if something goes wrong, the management is going to be able to do the right thing. So uh, a couple examples that have of good management in our portfolio is Domino's Pizza, like the company that I mentioned earlier. So Domino's Pizza, they in 2022, food inflation was going through the roof. Pizza demand was collapsing because everybody, during 2021, when everyone was stuck at home due to COVID, like people ordered a lot of pizza, people were ordering food delivery, and then the world was reopening, and so now people are going back to restaurants and they're not eating as much pizza. So what did Domino's management do? Is while all of their competitors were raising prices, just to preserve their margins, they decided to hold price on their national offer, which is the mix and match special. And I think and then they also went out and signed a partnership with Uber, right? So, which was one of the things that they said they would never do before. So I think they are I think to me, that's evidence that the management is playing the long game because they want to ensure that they are the best value in pizza. They are nimble. They are reacting appropriately to a changing marketplace when appropriate. Whereas I think there's a lot of businesses where if you just look at the earnings calls and how they're managing the business, is clearly very short term, right? The management doesn't have any skin in the game. They don't own a lot of stock, and what they really care about is to juicing up the quarterly earnings so that they get their bonuses. And I think if you follow a business long enough, you get to have a pretty good sense of whether the management is running it in an aligned manner with the common shareholders, or whether they're just in it for themselves. So I would like to think that most of the names in our portfolio do have that long-term orientation, and I think it's important, especially if you're not an activist investor.
We are trying to be ambassadors for holding high quality businesses for a long time. So I really I completely agree with you. But regarding Domino's Pizza, we have talked about the stock previously in our podcast, and the one main concern both me and Kenneth had was their debt levels. What do you think of it? Is it an issue or
No, so leverage is, I think a lot of investors look at leverage and say, like, clean balance sheet good, like high debt bad. And I think the way I look at it is leverage is mostly a tool that the companies can use. And you can use it well or you can use it poorly. And there's businesses that use leverage extremely well, like TransDigm, for example. Like, I don't know if you've ever talked about it on your podcast before. They use a lot of debt and they generated tremendous returns for shareholders. And then there's obviously companies that over lever themselves and then they blow up. And there's too many examples of that in history. So for Domino's, I think they can support a very high leverage because it's a royalty business. They, apart from a bit of supply chain and some company-owned stores, they essentially just clipping checks on the franchisees that go through the business. And they don't really have material capital investments other than in supply chain. They don't have, it's extremely high margin because there's nothing that they really have to do to earn these checks apart from, like, managing the franchisee relationship. And it's extremely stable, right? Because there's no cost in the business. So to the extent that the royalty stream continues to grow because they're adding stores and growing same store sales, if you're having a very safe stream of free cash flow, then the optimal capital structure is to lever it up. And so that's why companies like McDonald's or restaurant brands or Yum brands, like, they all run with very high leverage because, number one, you get the tax benefit, but number two, there's essentially no risk to having a lot of debt, given how sticky the cash flows are, right? And I think that's how I look at it. And it's not like they're going to go out and require the capacity to make acquisitions because it's Domino's Pizza. So what are they going to acquire?
yeah, it's a good way to look at it. So you're saying basically if they are good capital allocators, don't worry about the debt.
No, I think what you have to, I think what you're really asking when you look at the high level of debt is, are they going to get into any trouble because of the debt? And for something like Domino's Pizza or fast food franchising in general, it's not very likely that that would happen because these are, like, very stable growing streams of royalties that you can lever up pretty easily. And there's not very much risk as long as the business is being managed properly that they're not going to be able to, the cash flow is going to be in any trouble. And so, yeah, like, I mean, like, they still have to manage the debt structure and the renewals and all those things, but, like, that's it. A company like Domino's, you can lever up pretty well versus something that has a lot of capital requirements, that has lower margins, and that you just have a lower margin of error in terms of being able to make interest payments and principal payments. So that's why they have the leverage that they do.
And to our final part of the podcast, we're heading towards the end. We have a couple of questions from your listeners at your podcast and our podcast as well. And this is from Tina. Have Ernest Wong anything good to say about Hammond Power Solutions? How does he regard the stock?
No, unfortunately, I'm not familiar with the company, so can't make any comments about them.
How about the companies TFI International? I know you like that one, and Copart and Waste Connection. Have you anything to say about those?
Yeah, I think these are, without getting into too much detail, I think these are all companies that have run by long-term oriented management and have done a very good job of creating value over time. I think for TFI, I think the one thing that might be a little underappreciated is that the business today is very different than it was 5 years ago, because 5 years ago, a large portion of their business was from conventional truckload, which is a competitive low margin business. And today, they're no longer in conventional truckload. And most of their business comes from US less than truckload business, which is a much more higher return on invested capital business with network effects. And that's what has changed the earnings profile of the business. So that's one thing to keep in mind when you're looking at the business today.
I can see.
Yeah.
I can see. Sorry to interrupt, Ernest, because I put out some data of TFI International, and it's exactly like you said. After COVID, their return on capital employed has doubled in 2021, 2022, and 2023. But would you say their earnings are? It's kind of a cyclical sector, isn't it?
It's yes. At the end of the day, trucking is still a tough business, whether it's even in the less than truckload sector, but much less cyclical than conventional truckload, which is essentially a commodity business. So I think that's the main reason why the valuation of TFI today is higher than it was, even though even though it's still quite cyclical, but it's less cyclical. And more importantly, it participates in a more attractive segment of the trucking market. And there's a upcoming catalyst for a spin-off of the remaining conventional truckload business as well. So specialty truckload business that hopefully is coming in 25 or 26. And I think that's another catalyst that investors are looking forward to for TFI.
The other two companies, Copart and Waste Connection, do they have any tailwinds that could be good going forward?
Yep, Copart. They are what they do is they operate auctions where if you get into a car accident and the insurance company wants to declare it a total loss, they will likely take the car to a Copart auction. This business is benefiting from a variety of tailwinds. Number one is that insurance companies overall are totaling cars at a higher and higher rate because the returns that they're getting from sending a car to a salvage auction like Copart is more attractive relative to fixing it at a repair shop. And there's a few reasons for this. Number one is that cars are getting older on average in the U.S. So as they're getting older, the car is becoming less valuable. So less reason to fix it. The cars are getting more complicated. They have more technology in them, and it's more expensive to fix these kinds of things. And then lastly is that the whole industry, the repair industry, like they are raising prices because of labor shortage. So that's another reason why they want to total cars rather than fix them. And so Copart is benefiting from these tailwinds. They have a They have the best auction liquidity, which is important if you are operating an auction because they have the buyers all around the world, and they've done a really good job of operating the business with a long-term mindset. Like they own most of their land, so they can handle large surges of volume. Like let's say if a hurricane happens, they maintain a very, very clean balance sheet. So they're able to take advantage of opportunities for acquisitions or for share buybacks if the opportunity arises, which they have. And they've done a really, really good job of compounding value over the years. And then lastly,
Yeah.
for and then lastly for Waste Connections, I think the waste business is a good one to be in overall. It's gotten a lot harder to open new landfills, especially in the U.S. and Canada, because of the NIMBYs, not in my backyard. And so those that do own the landfills are benefiting proportionately from that. I think you add to the fact that Waste Connections tries to focus on like they only want to operate in markets where they can have better margins, like which are markets that are secondary, like more smaller rural markets that are not in like New York or LA, which are like there's a large bid every time there's a new contract renewal, and so they earn good margins and they have the right culture. So they have the best safety and injury rates in the industry, which is a very, very dangerous place to work. And they have they have better employee retention and save money on like employee claims and those kinds of things relative to other companies. And they continue to make acquisitions and has done a really good job over time as well. We've owned it for a while.
Yeah, both of these names are, especially Copart, is a quite new name on my horizon, and it's a really interesting business, and you can see really the long-term mindset that they've had over the years. It's really, yeah, paying dividends. Yeah, thank you very much for coming to us, ladies and gentlemen. This is Ernest Wong. It was a pleasure to have you on the podcast. Thank you so much for your time.
Yeah, happy to be here and enjoyed our chat.
Ernest, before we let you go, I have one final question, if I may.
Sure.
First of all, thank you so much for taking your time, and the second thought I had about ATB, how do you see the acquisition of 7-Eleven? How long do you think it will take before we get any answers? Because I found it weird when the bid came. The kind of reaction the market had was actually uh, uh, quite negative towards ATD, given it fell tremendously, and 7-Eleven stock got a boost up, and now you've seen they have declined the latest bid. How do you see it work behind the scenes, Ernest?
So the way these things typically work is that there's an investment banker, the advisor for Couche-Tard. They're gonna go out and do a lot of research and create a proposal together with Couche-Tard's management. They're going to create a proposal that I think they hope can meet all of the objectives that 7-Eleven is looking for, and then they'll negotiate. And one of the things we'll see whether or not 7-Eleven really wants to take the bid seriously. I think it's not clear to me that they actually want to be sold. Actually, I think it's obvious that they don't want to be sold because of the appeal that they made to the Japanese government. But I think it'll be quite a long time before we figure out what's going to happen, if anything. First, like there's not even a concrete bid today. Then there's the regulatory approval process. So it'll be a year or two before we get, unless we get closure on this matter very quickly, it'll be a year or two, if before we get a deal. So yeah, I think the market reacted a bit negatively about the deal, was more about the likely equity dilution that could take place for that would be required for this kind of deal. I think it's the market got it wrong, because if you look at the geography that 7-Eleven has, they're very focused on Japan and Asia, with a less of a footprint in North America and Europe, where Couche-Tard is very Europe and North America focused. And so it's really a perfect fit, in terms of the geographic footprint. There might be a little bit of divestitures that they need to make in the US, but nothing that they've never done before. And 7-Eleven trades at a fairly hefty discount to Couche-Tard's stock, even after the deal proposal was announced. So they're going to be able to go in and do the things that they normally do, like increase the return on investment within the stores, like add freezy machines or those kinds of things. And I think it's a really good deal.
But don't you think the dilution is kind of probable, because ATD is currently trading at a higher multiple when you compare it to the historical average? It's around 19 forward PE, and its historical average is around 17, 18.
Yeah, so even more reason to use equity, right? Because
Yes.
you're issuing more expensive equity, which I don't think it is that expensive, by the way, but you're issuing equity to buy a really, really good asset. So I think it's almost certain that they're going to be raising money from the Quebec pension, CAIS. I don't know if I'm pronouncing that correctly, but yeah, I think it's we'll see what happens.
It will be interesting. I remember a couple of years ago when they had a bid to the French retail giant Carrefour. I don't
Yes.
pronounce it correctly. I'm not that good in French, but that went on for 2 years before ATD kind of gave up on the acquisition.
Yeah, that one, the French government, I think, said no. So fairly quick decision. But in this case, the Japanese government basically said that, like, they're not going to interfere, at least for now. And so the process will probably drag on a little bit longer, as long as Couche-Tard is interested. I think one of the things that is a bit underappreciated about the overall situation is that how opportunistic it is for Couche-Tard, because right now is the time when the Japanese government is reforming their laws to make it easier for foreign companies to acquire their businesses. 7-Eleven stock has been underperforming for quite a while, and there's activist investors on board. And the yen is at a fairly low price. So I think it was very carefully timed by Couche-Tard to make this bid. And so we'll see whether they're successful with it.
Yeah, all the stars are aligned. I really like that thought, Ernest. Thank you so much, and we wish you all the best, and we hope you will come back to visit us again in the near future as well.
Sounds good.
Yeah, send our regards from Norway to Barry as well, please.
I'll definitely do that.
Thank you so much. Have a nice day.
All right, take care.